On January 5th, we saw the release of the minutes from the most recent Federal Open Markets Committee meeting. They showed a more hawkish tone, and it was revealed that several Fed members felt that they were behind the curve with tightenings to combat the current round of inflation. Now, the market quickly adjusted as two-year yields, which began the day at 0.77, quickly moved up to a current level around 0.94, and the CME FedWatch tool moved from pricing in 3/4-point rate hikes in 2022 to 4, with the first one coming as early as March. The 10-year yield also moved sharply in the same time period, going from 1.65 to a recent high of 1.81. Not surprisingly, risk assets like equities and cryptocurrencies were aggressively sold after the news as this new rate environment was priced in. Questions obviously remain. Could the pandemic significantly weaken the current economic picture and force the Fed to eventually reverse course? Or, as some anticipate, worries from the Omicron virus could soon fade, and perhaps there could be an explosion of economic activity into the spring. Now, if a trader believes that the Fed is going to be resolute in their move toward hawkishness and that short-end rates could move higher, an example of representing that view using CME January Micro Treasury 2-year futures priced in yield terms would be to buy at the current price of 1.01 and target January of 2020 levels, that's right before the pandemic, at 1.47. Now, a stop could be placed at 0.81. This trade could profit $460 if the target is reached and risk $200 if stopped out at your level. Now, if a trader believes that the Fed's recent tone is too optimistic and that yields could soon fall, an example of how to represent that thesis would be to sell that January Micro 2-year contract at a price of 1.01 and target this December lows of 0.61. A stop for that trade could be placed at 1.21. Now, this trade could profit $400 if the target is reached and risk $200 if stopped out at your level.